Greetings, everyone, and welcome to part 2 of my experiment, options versus stocks. And are options riskier than holding straight stock? And my theory is that no, they are not riskier. You can actually control your risk much better with options. Most people just don't understand how to properly manage their risk. In any case, so as you guys who have already seen my channel know, I've been running this experiment on AT&T stock. I sold a strangle and I simultaneously went over to Investopedia and purchased that same stock. So I bought 100 shares, which would be the equivalent of a strangle and T. Traditionally, I would be putting on if I were selling a strangle. So I'd be selling this at the expected move here. I would be selling the options right at the expected move. So that's a 20 delta and that's a 24 delta. That would actually get me positive 4 delta, which is interesting. This gives me a profit range outside of the current expected move for AT&T stock, and I'm just betting that it'll stay within this range by expiration, although I personally never hold till expiration. But you'll notice that my actual strikes, these are the actual strikes that I have in right now, are completely backwards from that normal position, and that is because of my trade defense. So if we pop into AT&T's chart here, I believe I put this trade on the 26th of February. I was right about here. So AT&T was about $37. It was trading from that range. And then we had this huge sell-off, and now AT&T is bouncing back slightly. So I put this trade on right here, and I probably sold like the 33 put, and then probably like the 39 or 40 call. And then we've got this sell-off. I would have rolled the calls down to defend, and then it bounced again, so I rolled up to the 37 put. And then if we go back to this position, during that whole huge sell-off, I just continued rolling my call. So I probably had like the 39 call. So I just rolled this call, buying it back and opening a new one lower and lower. Every single time the stock continued to break through further and further down. And then now, the stock has actually been rallying back, and I've been making back the money that I lost in that position. So now the stock is directly in between my strikes. This is ideal. Like if it just sits right here, all of the extrinsic value in my position will slowly start to come out. Now the only thing is I had to roll out in time because I had way too much risk of being assigned for the dividend on my calls. And those were in the money, as you can see. You can tell your dividend risk if the extrinsic value is lower than, where's the dividend? 52? Yeah, so 52 cents. At the time, my extrinsic value was right at like 40 something or other. And that was just way too close. It was very likely I'd get assigned on that. And I did not want to get assigned, and so I rolled out to the June strikes way earlier than I normally would have to avoid being assigned. I do have 94 cents in extrinsic value here and only 5 cents of extrinsic value on the puts. So that's not great because that means that most of this is actually intrinsic value, and so I'll only make money as this continues moving up. However, if we look at my deltas, I've got a 91 delta here and a 76 delta there. So there's a lot more delta weight on the puts. So I'll continue making money as the stock continues recovering. And I'll lose money as the stock drops. I don't know if that makes sense to you guys. But let's look at the results. So how much money, since I placed this trade on the 26th of February. Well, first we can look at the management and then we'll look at the actual results. So February 26th, I placed the trade, collected 109 in credit, and then as you can see, I rolled the calls down just like I said before. Rolled them down a couple times actually. Yep. And collected another $1.21, rolling the calls down. And then I started having to roll the puts up as AT&T had that bounce back. And I rolled the puts up and then had to roll the calls down again even further as everything sold off in February. And then collecting more credits, continuing to roll these calls down. Every time I'm rolling these calls down, I'm collecting more credit, but that's also locking in profits on those calls, even while I'm losing money, like losing on the puts. So, and as you can see, I'll roll down my calls all the way to the 27 and a halves. Yep. And then realized I had that dividend risk. And so I rolled out, collected more credit, rolled the entire trade out, and then made another roll. So wait, this was oh yeah, so this I rolled out to May, and that was on the 26th of March. And then on April 7th, so about a week and a half ago, I rolled out to the June strikes early to avoid getting assigned on my calls because I did not want to get assigned. Now, that's a lot of active management, and the result, as you can see, is my positions are completely inversed, 100% inversed. So I've got an inverse straddle on, an inverted straddle, I guess, and that's perfectly fine. The risks are the exact same. So if we look at this straddle, inversed, my profit zone is this green area, and I'll still make money as long as it stays anywhere within this green zone. So I'm still going to be making money on AT&T. My risk is just flipped, and this requires more buying power. So it requires $624 in buying power at the moment for me to hold this position, which is a little large for my account, but I wanted to do this just for the trade. And IV is still at 53, which is fantastic for me. I'm just collecting more and more IV, and as I continue collecting IV and as that IV slowly reduces, I'll make more and more on the trade over time as well. So I've got plenty of room to defend this, and there's no reason for me to get out. Now let's take a look at the long stock position. Pop back into Investopedia. So if you had purchased 100 shares, which I did not because I don't buy shares very much anymore, but if I had purchased 100 shares, I would be out $620 as of market close on Friday. That's down 16.56%. I would have needed $3,743 in order to put the trade on, and that by itself is a ton of capital to use on a single trade, especially if you have a smaller account like mine. Whereas to place the trade, I only needed, I think it was like $500 was my initial like buying power requirement. That's like 1/6 of the amount required to place this trade right here. Let's go back. So that $620 loss, let's compare the results in AT&T here. So my P&L realized to date is $360, negative $360. At the moment, I have an unrealized $35 gain in my current position as the the inverted strangles slowly losing value over time. And net, that's a $324 loss on the year. $14 in commissions to do all those rolls and everything. So that's not bad. That's almost $300 or half the amount of risk while using like 1/6 of the capital in order to place the trade. Now, at the height, I was required to hold, let's see, I think right now, just because of how far the puts are in the money, I have to have about $700 or $800. Let's check that real quick. Capital requirements. So we'll just see what the cap requirements are on T. So initial requirement and the maintenance requirement. Okay, so it's $1,600 now. So it's requiring a lot more cash than it was to open. But on the buying power effect is only 624. That's interesting. But yeah, to maintain the position, I need $1,600 in there. That is still less than half of the amount of capital required to put on the trade and lose money and stuff. So, I mean, that is fantastic. So, in terms of how much money you're putting at risk versus how much, like, you can control that risk, there's no way to control your risk with the stock. With the options, I cut my losses in half, and I'm still in a great position to break even on the trade. I might even break even faster than the stock recovers. There's a lot of factors that go into that, but I should be able to break even, maybe even faster than the stock recovers, and start making profits sooner. So I'm going to keep you guys posted on how my position goes in this experiment. But I just wanted to show that if you are managing your options very aggressively and you take great strides to minimize your risk, like you trade small, you trade what you can afford to lose. Like I kept it small enough so I could roll with the losses, and that way I can continually manage the position, and eventually I'll at least break even, if not begin making some profits. So we'll see. It'll be interesting to see how things play out, especially with how crazy the market's been. Thank you guys for watching. It's been fun explaining this trade, especially since I put this on literally right before the market crashed. That is the worst possible time to buy stock and the worst possible time to sell a strangle. And as you guys can see, I am down money on the trade, but it's not unmanageable. So even though I just went through one of the fastest declines in history in the stock market, I was able to manage my portfolio of options, and we're almost back to even. We're just cracking the $500, like $500 in losses. So for the year, so pretty soon I'm gonna turn that green. Hopefully we don't get too many huge moves, but again, things seem to be calming down, but again, you never know. Have a wonderful day and happy trading, guys.